The US recently imposed tariffs on imports from several countries including China, Mexico, and Canada. These tariffs, aimed at protecting American industries and addressing trade imbalances, have sent ripples through the global economy. China, Mexico, and Canada have retaliated with their own tariffs, escalating trade tensions. This essay will examine the potential impact of these tariffs on various sectors, focusing on the opportunities and challenges they present for India. These tariffs have introduced uncertainty into global trade. Businesses are now grappling with higher costs and disrupted supply chains. While the full impact of these tariffs is yet to be determined, it is clear that some countries, like India, may find themselves presented with unique opportunities to expand their global market share. The following sections will delve into specific sectors and analyze how these tariffs might affect India's economic landscape. The pharmaceutical industry presents a mixed bag for India. On one hand, Indian pharmaceutical companies stand to gain from the increased costs of Chinese pharmaceutical exports to the US. India is already a major supplier of generic drugs to the US, and these tariffs could make Indian generics even more competitive. Companies like Cipla, with its established US presence, are well positioned to capitalize on this shift. Divi's labs, a contract development and manufacturing organization, could also benefit from tariffs imposed on Chinese CDMOs. However, the chemical sector tells a different story. Indian chemical companies such as Vinati Organics and Navin Fluorine face limited competition from China in their specific product categories. The tariffs are unlikely to significantly alter the competitive landscape for these companies. Additionally, the cost of manufacturing chemicals in the US remains significantly higher than in India. This makes it unlikely that US companies will shift their sourcing from China back to domestic production. While the tariffs might offer some marginal benefits, they are not expected to be a game changer for the Indian chemical industry. The oil and gas sector is expected to experience a relatively neutral impact from the US tariffs. The US has diversified its oil imports, reducing its reliance on any single country. It can easily source oil from other producers, such as those in Latin America, mitigating the impact of tariffs on Chinese oil. This limits the potential for disruption in the global oil market. The automobile industry, however, faces a different scenario. Indian automakers, particularly Tata Motors with its Jaguar Land Rover brand, could be negatively impacted if the US decides to impose tariffs on European car imports. Such a move would directly affect Tata Motors' exports to the US, potentially hurting its sales and profitability. The company will need to closely monitor the situation and adapt its strategies accordingly. The cables sector presents a significant opportunity for Indian companies like APAR Industries. APAR Industries already holds US supply licenses, giving it an edge in the market. While Chinese dumping, where products are sold below market value, remains a concern, the tariffs could provide APAR Industries with a more level playing field. The metals and mining sector also holds potential benefits for Indian companies. Jindal Stainless, a major stainless steel producer, could gain from tariffs imposed on Chinese stainless steel. However, Chinese dumping continues to threaten the global steel industry, and Indian companies remain vulnerable to this unfair trade practice. Tata Steel, with its European operations, might see a minor impact on its exports to the US from its Netherlands facility. In the capital goods sector, companies like Praj Industries and LG Equipments are well positioned to benefit from increased US investments in infrastructure and manufacturing. Praj Industries, specializing in ethanol plants, is expected to see increased demand as the US promotes biofuels. LGI Equipments, with a significant portion of its revenue generated in the US, is also likely to benefit from this trend. In conclusion, while the US tariffs on China, Mexico, and Canada have created a climate of uncertainty in global trade, they have also opened up potential opportunities for Indian industries. The pharmaceutical, cables, metals and mining, and capital goods sectors are all poised for potential gains, while the chemical and oil and gas sectors are expected to see a more neutral impact. However, the automobile industry faces potential risks. How these opportunities and challenges ultimately play out will depend on how the trade war evolves and how Indian companies adapt to the changing global trade landscape.